You don't in an ETF usually get distributions that are taxable the way that you do in a mutual fund because of the way the money is going in and out of the mutual fund. That is the central argument. But Jonas, I know that you know a lot about him as well. He's getting into them. He says people make them needlessly complicated.
Well, it can be a very complicated question, but I'm going to simplify it. And first of all, ignore all these fancy new ETFs with the leverage because they're actually very tax inefficient. Pure vanilla ETFs are index funds, no different than open-end mutual fund index funds, and frankly, the tax benefits are in most cases very, very similar. There are some weird costs on both sides, but the ETFs have weird costs. You got to trade in and out of them. You go to Vanguard and buy an index fund. It actually can be the lower cost option over a lifetime, particularly if you're adding money regularly, because you will not have to pay commissions to do it. I still prefer the open-end Vanguard index funds for broad market indexing than the ETFs in many cases.
Paul, what Jonas is saying is that when you buy and sell an exchange-traded fund, you pay a brokerage commission.
And it's bid-ask spread loss. You lose money on the spread.
It's as if you're trading a stock. That's the big difference between exchange-traded fund and a mutual fund. You can trade it throughout the day, which also means you run the risk of trading it like a stock. A mutual fund, basically your trade is made at the end of the day when the thing settles up and the closing price
Short
is
story,
there.
if you're investing a small amount of money and you tend to make multiple investments over time, the Vanguard open-end index fund is the way to go.
Right,
And
automatic investments.
One thing to add as well is,
Go ahead, Jacob.
one thing to add as well is when you're talking ETF or traditional mutual fund, we're talking about passive money or active money.
Exactly.
When you're going into a mutual fund that has a mutual fund manager, yes, the costs are higher because that individual or that team is constantly buying and selling stocks and bonds on your behalf throughout the year, so the costs will be greater. Now, if you feel that an active manager can do better in these times than a passive investment like an index, you might want to lean towards an active, and that's always a debate. No one ever knows what's going to do better in the future, whether it's active or passive, but they both have their benefits, and in many examples it makes sense to have both in a portfolio, but it's difficult to point out whether one's better than the other.
But people, to Paul's point, people talk about ETFs as if they are some sort of magic investment. They are not. The vast majority of them are index funds that you can trade all day long during the trading day. That is the only difference.
And today, there's a bunch of ETFs that cost more than actively managed funds like Dodge and Cox. Actively managed fund is cheaper than ETFs.
The fees have increased on these things because when you started covering them, they came out, they were dirt cheap. And then there was thousands of them, and all the fees went through the roof, so you got to be very careful.
It just depends on the type of ETF that you're talking about, because the ETFs have become a great deal more complicated. There are leveraged ETFs that are exceptionally risky. Those are more expensive. You have bond ETFs now. You actually, let's not